Good morning, traders and investors. This is Roger Scott, Senior Strategist for Wealth Press. It's Wednesday. It's March 8th, 2023. It's about 7:42 in the morning, and all I'm going to say is, I hate to say, but I told you so. That Powell, boy, that Powell. We'll talk about him in a minute, too. Talk about Mr. Backtracker. NASDAQ 100's down 1%, not 1%, 1 point. Dow's down 11 points. This is randomness, real randomness. Now, before we get into the analysis, one saving grace from yesterday is, and this is actually really impressive, the bond market. The bond market, let me show you a day's range yesterday. So this was today's what? Today's the 7th. Let's see here. Let's go 5 days. Notice the bond market rallied yesterday and stayed up. It did not go down. It kind of closed in the middle, even though the Dow Jones dropped. That's actually really positive in light of what Mr. Jerome, I'm going to backtrack everything I said before Powell said. So that's actually very encouraging. And I know we saw a lot of gyrations in the S&P yesterday, but if you look at the Dow Jones, I want to show you something. We're only back in that range. We haven't broken out of that range, which, by the way, is very, very similar to what we're seeing with the bond market. So I'm not going to say the party's over yet because we're not going lower. If we crashed and burned yesterday in the bond market, that would be a one thing, but we didn't. And yes, we did see a lot of volatility, but we're still in that range. And I'm not trying to hold on to the bulls. That's not what I'm doing here, but I think that's a very, very positive sign. The fact that the bond market did not decelerate so much is very, very positive. And again, we're in that range. So if this range holds and we undo this and come back up, it would just be a little delay of action and we would still be headed up here, as I expect we will. I don't see us breaking lower because most of the data is out. The Fed is already pricing in 0.50 rate hikes. So to me, I think for now, for the time being, this will hold. You know, one thing I want to do is I want to take a look at the Russell 2000 because I think the Russell 2000 IRW, is it Russell? IW, I'm sorry. I get confused. There's so many Russells. If you look at the Russell 2000, it was only down 1% yesterday, and it still is within range right here too. And old friend Kathy, whose negative earnings, didn't really mess with her too much. Look at her. She's still in the middle of the range. So honestly, there's a good chance this is a more of a washout and a panic than anything else. And I'm going to tell you the truth. I honestly would think opposite if the bond market broke, but the bond market did not break that level. And again, it's only putting QQQ back in this range. So to me, thus far, it looks like we're just going back into that range, or there's a confirmation that economy is not growing as fast as we thought, which by the way, every Fed except for Powell has been saying, every Fed for the last 2 months has been saying, we probably need to go further, harder, and stronger than we did before. And Mr. Jerome, I'm going to backtrack everything. Powell is going to speak today at 10 o'clock. Now, let's talk a little bit about the news. Now, tell me if I'm crazy, but do you guys remember the last time he spoke to the committee, he said that he used the word deflation? He used the word we're starting a deflation period. Do you remember that? Or am I Looney Toony here? Because I can look it up. Let me see here. Let's see. Powell said deflation starting to ease. Yeah, February. It's right there, February 7th. All right. Powell's disinflation has begun. There it is. I got a quote from him right here. It only took me 10 seconds to do it. But he said, if we continue to get, for example, strong labor reports, high inflation, it may well be the case that we have to do more. But he said disinflation. He used those words. He literally did. Begun. Disinflation has begun. February 7th. I thought I was maybe I was losing my mind. But here, Fed Jerome Powell sticks to disinflationary script. Right? And again, he's talking today. Well, I'm going to tell you something. I didn't hear anything about disinflation yesterday. Did you? Did you hear him say the word disinflation? I'm telling you, this Powell is the only guy. Everybody else in the Fed has been honest, and this guy's he's just so, don't get me started. Anyway, three major benchmark indices finished regular session sharply lower as Jerome Powell's remarks on Capitol Hill took a more hawkish tone than investors expected. Like nobody saw it coming, right? I did, and I told you guys about it. Ramping up bets on return to faster monetary tightening. Ouch. In Tuesday's session, stocks plunged, treasuries gained a little bit after Federal Jerome Powell said interest rates would likely need to head higher than policymakers had expected. Remember I said they're not going to get down to the 2% rate by going to 5.25. They're probably going to go to 5.86. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. That's called pulling the chair underneath you, guys. I don't know how else to say it. The central bank leader told U.S. lawmakers, in addition, Powell cautioned that the Fed might increase the pace of interest rate hikes. Disinflation, my ass. Sorry, guys, I'm just getting really worked up here. If the totality of the data were to indicate the faster tightening is warranted. But here's the bottom line, and here's what I like. As Powell comments, U.S. futures have priced in a 28% chance of a 25% base point hike and a 72% of a 5.0. So the bond market has already assimilated the 5.0 beyond 50%, and it still hasn't gone down. And that's giving me hope, not just hope, but some idea that the market will stabilize today or tomorrow and start coming back up and not break down. I think if the market was going to break down, I think we would have already seen it yesterday. I think we would have seen it right here. Let me show you. I think we would have seen it come down right here. And I also think the Dow Jones, and I'm looking at the Dow because they're very highly correlated to the Nasdaq right now and to the bond market. I think we would have broken. I think there's nothing would have stopped us from breaking. Now, could we do it today? Yes, but I don't think we will, because I think the stock market is getting way, way, way too much directional bias from the bond market. Let's continue. In corporate news, Dick's, who sold my daughter 2 left shoes on Sunday, no joke, two pairs of left shoes she got, so we have to go back and exchange one, closed over 11% after the retail reported upbeat fourth quarter. Also, the fact that COVID's not around means more people are going to be going out, doing sports things. And by the way, I love Dick's Sports. I think it's absolutely amazing. They have great stuff there. Highly recommend it to anyone. I'm big on sporting good clothing. I'm very casual, so I kind of go there all the time. But I think we're going to see more upside from sporting goods stores this quarter, especially as we head into the summer. So pay attention to that. All eyes are focused on ADP non-farm report. That's coming out in a couple hours. That's the private report. It's actually coming out in less than 25 minutes, and it's going to give us an indication of where Friday's employment data will stand. Now, let's continue moving ahead. I'm going a little slower today than usual because there's just so much to talk about. Also, investors will focus on Federal Reserve Powell's semi-annual monetary policy testimony before the House of Representative Financial Service Committee. Well, that's going to be a doozy. U.S. crude oil inventories will be reported as well. Economists estimate this figure to be 0.395 million compared to 1.165 million. It'll be very interesting because I think energies are going back up, and I've been telling you that too. Don't rule out energies in an inflationary environment. That's a fool's play. And as we see by Powell turning on a dime, he did say disinflation. I knew it. I'm seeing it right here, that rascal. Sticks to disinflation. It was only a month ago. Literally, it was a month ago. It was a month ago today that he said it. I have it. I have a quote from him, that rascal. I love the fact that the internet captures these quotes. So again, the Europe went a little higher. They were disappointed by Powell, but again, Europe is right now really taking its cues from Germany, and Germany is starting to make moves again. China closed lower amid hawkish comments from Powell, growing U.S.-China tension and mixed trade data weighted on investor risk appetite. Now, instead of hearing about COVID, we're now hearing about that it came from China, from federal sources here, which is putting more pressure, but less people are getting infected. So I don't mind the political turmoil. I just don't want people getting sick. Their COVID restrictions have eased, and we have not been hearing anything about COVID for about 2 months, maybe month and a half, two, maybe more. Time does get away from me. But from what I'm understanding, their economy is not bouncing back as fast as they wanted to see it. So that could be an issue. At the same time, the Nikkei stock index closed higher after weak data released this week, bolstered expectations that the Bank of Japan will keep its ultra-accommodative policy stance near term. They're just putting their head in underground and keeping their rates low till the world recovers and they just want to piggyback on that, which honestly is not the worst idea. They can afford to do it because they're not China or US. If they were a bigger economy, I think they would be pressured by the world to take a different position. A CrowdStrike gained over 6% in pre-market trading. Very good stock. Cybersecurity companies doing well. And keep your eye on Tesla. It was downgraded by a small company, but Tesla has a lot of market cap. So we got to be very, 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 very cautious. Now, again, as I mentioned to you, stocks are down right now. The sentiment on Wall Street is bearish. I told you that these things were going to go down. I remember somebody with the name Roger telling you right around here. Hold on a second. Where are we? Oh, sorry. I remember somebody telling you that this was going to end up going down, and where it is right now, we broke below that level. It looks like the stock market is going to come down a little bit more. Doesn't mean it has to be today, but the sentiment isn't all that great. Now, that's the 50-day line, and that's the S&P. Only 36% of stocks and only 53 are above the 200-day. Dow Jones, forget about it. 49%, 37%. Now, in terms of deals, bargains, and all that other stuff, utilities looks like it's way, way overdone. Way, way overdone. Consumer staples looks like it's really bottoming out. Let me show you what I mean. Right there. Looks like it's bottomed. So I'm starting to see a little more defensive upside and offensive speculative activity going down. Look at consumer discretionary. They looks like it can go a little lower. It's only in the 50th percentile. Meanwhile, let's see here. Information technology, 46th. So let's be cautious. I think these speculative sectors have more to go, which would totally be confirmed by my sectors, which are still out of whack. Industrial, energy. Why is communication services above material? It has no business being there right now, especially with Powell singing the song that he's been singing this morning. Consumer staples need to come up. Healthcare needs to come up. Consumer discretionary needs to come down. I'm still seeing a huge fragmentation in this market. And anytime we see a fragmentation, that does not yield well. Now, folks, we got to be really, really cautious today because the sentiment, look at the S&P, Infotech coming down. Let me show you the NASDAQ. Still coming down. Not seeing any rainbows, fairies, or anything on the horizon that's really all that great. I think more consolidation, more downside. Let's look at the Dow. Let's see where the Dow is right now. Yeah, it looks like it could be turning. I don't know. The bottom line is you got to be really, really cautious right now. My advice to you is this. Seriously, this is good advice. Let me just change this to a different template here. Okay. My advice, keep your eye on the bond market. If the bond market starts coming down and breaking this level, the TLT, the 100 level, we could be going down some more, and that would push the Dow Jones down. If the bond market starts coming up right now, especially after Powell talks and after the 0.75 has already been priced in, then there's a good chance we're going to go the other way. But you got to be really, really cautious right now. You got to be really, 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 really cautious right now. And I mean really careful, because if the Dow Jones breaks the 32,600 level, ouch, it wouldn't be pretty. It wouldn't be pretty. But what I'm thinking is we're going to go through a period like this where there's just very little consolidation, very little directional range and bias, and a lot of volatility, which is perfect for traders, but not so good for investors and for investors who are longer term. Now, my advice to you right now, the sector fragmentation is taking place. You don't want to be in, you really don't, you got to look at individual stocks right now. Don't look at the sectors. A lot of sectors have good stocks right now, but you got to look at the right ones. So let me give you a couple. United Airlines is looking really good right now. Look at this consolidation. It's looking really good. I've been talking about it for a few days. TDW, Tidewater, it's looking really good right now. Really good right now. In terms of the large caps, let me show you where the action is. Steel Dynamics is looking really good. Lamb Weston is looking really good. Las Vegas Sands is looking really good, and Wynn is looking really good, and United Rentals are looking good. To the short side, you've got so many stocks. Tyson Foods is not looking all that great. CVS is not looking all that great. Bristol Myers is not looking all that great. So we have some stocks to the upside and we have some to the downside. Now, before I let you go, folks, investors have more than $4.5 trillion in cash stashed inside money market accounts, just waiting for the right moment to get back into stocks. This could trigger a profit surge, the likes of which we haven't seen in a long time, sending a handful of stocks surging higher within weeks. Now, you want to know where all the money is going? Join me at 1 p.m. today, Wednesday, 1 p.m. special presentation. I'll reveal everything to you and I'll give you an update on what this Fed is doing. Follow the link below this video and check out this class. Do it now. Don't delay. Don't procrastinate. You're going to get pure value out of it. I'm going live at 1 p.m. today and I'll talk to you guys soon. Bye. Remember, comments below this video. Bye. In the YouTube channel and like us. Bye.